Good morning, everybody. Welcome to the morning meeting of our virtual hedge fund. Let's go over our strategy today. I'm going to share with you our macro approach. Call that ARMR Macro, where we trade double or triple the indexes using our algorithms. Then we're going to switch over to our ARMR Invest portfolio, where we're putting capital to work, building alpha wherever we see the puck going, not where it is, but where it's going. So we'll focus on top stocks to watch, top stocks that we're buying in that portfolio, some that we're selling, right? We're going to talk about a stock we removed yesterday. Then, of course, I try to wrap it up in a bow for you, and I call that the ARMR Flagship Fund. So that's how I use all this information to manage capital for others. Of course, I manage my own family office, Rosenthal Capital Management, and I share with you my strategy and my process. Ran hedge funds for a decade, been running money for 35 years. And so I'm sharing with you a strategy that is led by the philosophy that we have to manage risk first, capture upside second. It's called the ARMR report for a reason. Stands for Algorithmic Risk Management Research. The difference between a professional money manager and an individual, what really separates the two is how we manage risk. And so when you're on this desk and you're listening to me and you're thinking about it, at the end of the day, whatever I say, it aligns with my risk tolerance. Yours may be different. So I respectfully request that when this conversation's over, find a quiet place, figure out your strategy, figure out your risk tolerance, build a strategy around that, and be the smart money. Okay, so step one for us, everything flows from our risk monitor. The risk monitor's yellow, nothing's changed there. By the way, as I'm having this conversation with you, don't forget, throw a comment into the comment section during this live stream, and I'll try to get to some Q&A at the end of the stream if you have a question. Also, don't forget we have a free Substack, right? armorinvesting.substack.com. It's where we post all of our research, and I'm going to talk about a stock that we've been buying recently. Stock was up big yesterday, and I expect it to be a cornerstone of our portfolio. We've posted for free our research on why we're doing that. So that's ARMR, ARMR, investing.substack.com. All right, so the way we put capital to work, we want to get on the right side of probabilities when rewards worth risk. You're going to hear me saying that over and over again. Everything we're doing here has to do with statistics and probability. If we execute our strategy correctly all year and we keep putting capital to work when the probabilities are at their highest and reward is worth the risk, we come out ahead. So the only way that doesn't work is if, one, we deviate from the strategy. In fact, that's the only way it doesn't work. It's just statistical probability. And I think that most people in this investing world get lost in the stories, in the folklore, in the conspiracies, and they totally forget that this is all about discounting the probabilities, putting capital to work when the probabilities are overwhelmingly in your favor, and then managing that risk. I mean, just because probabilities are in your favor doesn't mean you make money. Anybody who plays, poker with a bunch of friends every Friday night understands that, right? You get dealt aces, you have an incredibly high probability of making money. Sometimes somebody gets lucky on the flop and you lose. So probabilities and statistics, you want to get your capital in when you have the best of it, and you want to keep your capital out when you don't. The major difference between what we're doing and that analogy to Texas Hold'em is that you don't have to go all in and lose it all, right? You go all in and you have a stop. It's not working. take the capital out, wait for the next opportunity. Statistics and probabilities. That's what drives everything we're doing here. And the understanding that whatever I'm about to tell you is not a guarantee something's going to go up. It's just getting on the right side of probabilities over and over and over again. So is there a place for the fundamental storytelling? Sure, that's my whiteboard. My whiteboard's full of all of my favorite stories. I'm going to share some with you today. It doesn't mean I don't believe them. I do believe them. Execution and timing and risk management is the key. There's always going to be great stories. Let me give you an example right now. We've been crushing it in the precious metal space. Right now, I have my smallest allocation to gold and silver, okay? In the mining stocks, my smallest right now. Over the last 9 months, smallest right now. We booked profits near the top. And I now have to wait for the right technical analysis chart pattern matched with the ARMR algo buy trigger to get me on the right side of probabilities when reward is worth risk before I can put the money back to work. There are those who will talk about the conspiracies of why gold and silver were down last week. I don't care. There are those that are going to talk about V-shaped bottoms. Sometimes they work, but V bottoms are notoriously difficult. They are statistically low probability events. That doesn't mean you can't find one every now and then. It could be a V bottom in the metals. If it is, and gold and silver just skyrocket, I'm going to have my allocation. It's the smallest I've had in the last 9 months. And I don't care. I'll make whatever money I can make because I don't invest in V bottoms. Statistically, they don't work. The probabilities of them working are small. Hey, man, I can go play craps. I can throw the dice, and sometimes it's snake eyes, 42-1. I can bet on that. There's a reason it's 42-1. It doesn't come up very often. Okay? But it happens. So if it suits your risk tolerance to put capital to work, hoping for a V bottom and believing in a conspiracy story, then go do that. Vaya con Dios, brother. I hope it works for you. It just doesn't fit my risk tolerance. In order to get me long those assets again, I need volatility to compress around a key location with an ARMR algo buy trigger. And it's going to be tough. That V bottom's going to hit and they're going to skyrocket again without me. It's going to be tough. You go make your own decision. This is how I run money. I have a lot of names on my whiteboard. If I don't get a setup that statistically for me is a high probability entry point when my reward is worth the risk, then I don't put money to work. That's why I have a whiteboard, because something is always coming off that whiteboard. I can tell you that with a fair amount of certainty. There are many different ways to skin the cat. Shear the sheep. Let's put it that way, because we don't want it to die, right? There's many different ways. There are many ways to make money in the market. I'm going to find the one that suits me and that fits my risk tolerance. I do want to add the 6 miners that I've been talking about. ARMR insiders know what I'm talking about. ARMR report subscribers, you guys know what those 6 stocks are. I shared it with you in the morning meeting notes. I call them the captain's log, right? could see the stocks I want to own. I am going to position those over the next weeks, days, weeks, probably over the next weeks. You'll see me build up those positions unless V bottom and everything is skyrocketing. Then I won't play this round and I'll get the next round and I'll focus on other investments. So let's go talk about that now. Risk monitor's yellow. I don't see the risk monitor turning green. We just had a non-farm payroll number. Market's up right now on the non-farm payroll number. I just think the whole thing is just comical. So we had a bunch of Trump administration officials over the last couple of days prepare the market for a god-awful non-farm payroll number. And then we got a better than expected number, 130,000 jobs versus 66,000. I think it's so funny. The unemployment rate went down, 4.3 from 4.4. Government numbers are such a joke. I don't care about them. All I care about is a reaction to the news. Okay. So right now, if you look at this, these are our 8 equity indexes we use in our risk monitor to decide direction and risk monitor color. It's yellow right now because there is money being made in many different sectors of the market. Okay. But it's also dangerous. It's treacherous right now. And over here, this top right here is what I'm looking at. And at the moment, I'm running a true hedge fund. I'm short the NASDAQ 100 while I'm long everything else that where the risk reward sets up for me. So I'm running a true hedge fund right now. I will cover my Q short if it closes back above the 50-day moving average. I'll say, okay, I don't need to be short right now. But let me show you a chart pattern that interests me. Well, not a chart pattern, but more a statistic, okay? Let me share with you this statistic right here. It's the energy sector versus the S&P. Now, the energy stocks represent the largest exposure in the ARMR flagship fund right now. Okay? Quarter to date, energy stocks are outpacing the S&P 500 by nearly 19 percentage points. Now listen closely. That's the best first quarter. That is the best outperformance in any quarter since the first quarter in 2022. Energy sector outpacing the S&P by 19 percentage points. That's the best since the first quarter of 2022. And one of the best performance spreads, and here's the part, gets a little dangerous. The best performance spreads since the year 2000. Now that is just not that's not the type of company you want to keep if you are an investor in momentum, innovative growth, NASDAQ 100, big cap tech stocks. 2022 and the year 2000 were just god-awful years for innovative growth and big cap tech. And energy was on fire. So I'm short the NASDAQ 100 right now, but we are long all kinds of energy, okay? This bottoming pattern, I like to say that on this desk, we like to go where the puck is going, not where the puck is, right? If you want to score a goal in hockey, if you don't mind this hockey analogy, you know, let somebody else dig in the corners where the puck is and you position yourself in the slot. Bang, the puck goes there, you bury it, okay? So this is the chart for me of where the puck is going. Long-term downtrend in APA, breaks the third Fibonacci fan sequence on the down here, pops back above the 200-day moving average, consolidates for a while, and then takes off. That is a chart pattern that's made us an insane amount of money over the last few years together. Just for those of you who are uninitiated, I'll give you an example. BTU, okay, that's the pattern. We made a lot of money. How about British Tobacco? Okay. That's the pattern on British Tobacco. That's the pattern. We made a lot of money. Okay. AT&T. That was the pattern. We made a fortune, doubled money, collected 8.5% yield. The list goes on. And so what do we own now? Energy stocks. Energy stocks have built that pattern over the last 6 to 12 months, and we've loaded up on energy stocks in these green boxes. Okay. Say SM. Okay. Exxon. In the green boxes where we're long energy. CVX. CNQ. You can see the similarities in all of these patterns. So at the moment, we're running a real hedge fund on this desk. We're short big cap tech. We're long energy in a big way. It's probably 35 to 40% of the flagship fund is energy. Oh, don't forget, we started all this with our pipeline investments. Okay. We've been long pipelines forever, but we added to them right there in the green box. KMI is one of our favorites. And then OKE is just a no-brainer chart. Oh, it's beautiful. There it is. That's the pattern. Okay. So now, simple. When I'm short something, like I said, I have a very tight stop. NASDAQ's up right now, right up near my stop. If it follows through today, I'll be out of the short side. I won't need to be short. But if this is a repeat of the year 2022 and a repeat of the year 2000 in any way, history rhymes, it doesn't repeat. So some other way, it doesn't have to be a crash in tech, but just something like that, then I might be making money on both sides of the ball. Okay. Let's throw in a discussion I was going to have about Treasury bonds right now. We got another ARMR Insider or ARMR Algo buy trigger down in here. So we've seen a couple buy triggers. These green boxes down here are algos telling us to get long Treasury bonds, right? And it just happened again yesterday in front of the non-farm payroll number. And now Treasury bonds are getting whacked, right? Because the number was better than expected, blah, blah, blah. So I don't know if I'm a buyer of bonds right here, but I did want to point this out to you. Bonds are a weird thing. You really want like the Goldilocks. I don't want TLT blowing out to the upside. You know, the last time we made a fortune on Treasury bonds was January, February of 2020. As the pandemic got started, Treasury bonds skyrocketed as everything else was crashing. So I'm not looking for that. I really hope that doesn't happen. Okay. But at the same time, you don't want Treasury bonds breaking down big, which means rates are going up a lot and you know, all the issues that entails. So right now it's Goldilocks. It's just right for Treasury bonds. I'm watching them closely. Do I want to put them into our macro fund as a hedge? I'm short the NASDAQ 100. Do I want to be long Treasury bonds as an expression of the risk monitor? I might put some Treasury bonds into the macro fund. We're long physical gold in that fund. I'm short triple Qs in that fund. I might be long TLT, particularly on the weakness here. I got to see how today plays out. I'll either be removing my short because today plays out strong, or I'll be still short and I might be long Treasury bonds that I pick off on weakness this morning. We'll find out at 9:30 when we all start trading together. ARMR Insiders. We'll have a focus on that. So I just wanted to share that with you. Now let's go over to some top stocks to watch, top stocks to buy, top stocks to sell. Let's start with stocks to sell. Okay. We had a position on Charlie Schwab, and we have a report written for you up in our Substack. Go subscribe to it. It's free, armorinvesting.substack.com. And I wrote a report there explaining to you that I thought 2026 would be a great year for Schwab as it benefits from all the hard work of acquisitions and incorporating those mergers last year, and we should start to get a return of capital to shareholders. All of that I still believe. It's all true. I sold the whole position yesterday. I had to do it. First of all, my stop got run. Okay, so I use stops. Remember what I said about whiteboards and stories? Investing ideas are all stories. All I care about is protecting my capital and growing my capital. I don't care about falling in love with a story. It's a very hard thing. I have a Substack. I tell you what I'm thinking. And in the world we live in, analysts just fall on their sword of an investment idea. They love it all the way down as it collapses 30 to 50%. They keep telling you why it's such a great idea. I don't do that here, okay? I'm sharing with you ideas on my whiteboard, and that's Substack. I like all those ideas. I think there'll be a time where I own Schwab again. But I manage risk on this desk first, and then I capture upside. So when they crushed it yesterday on what I thought was a ridiculous story, okay? Maybe I just don't get it. Maybe I don't get it. There's a story of an AI agent that's going to somehow cut into the revenues and margins of brokerage firms. Okay, maybe, because the brokerage firms like Schwab have been they've been holding themselves out more as financial planners than as intelligent individuals who help with investing, because most people aren't intelligent and can't help with investing. So once they figured out that their brokers haven't the slightest idea what they're doing, the entire investment banking, the brokerage business shifted away from the individual investment advisor who will help you make money in the market, because most of them can't. So they said, okay, we're going to shift away from that, and we're going to be the guy who helps you with financial planning, okay? And you're going to give me whatever fee to do that. That was the argument, and I get it. There's nothing wrong with that. Most people can't make money in the market, and so most brokers blew up their book. And so over time, they shifted to index investing, and then we'll take our fee by explaining your financial plan. Okay. And so what happens now is, if there's AI bots that will help you financially plan for free, or for a nominal fee, you don't need to pay Schwab. I think that narrative's crazy. It might be true years from now, I guess, but I don't know how it affects this year, but I don't care. I don't argue with price action. When the stop gets run, bang, I go to cash, and Schwab goes back on my whiteboard, and we'll watch it for another day. That's the top stock we had to sell. All right. Top stocks to buy in the portfolio. You've already seen a number of energy stocks that we already own. We've added shares of LNG to the portfolio there in the green box. Okay. Same type of pattern. Smaller Fibonacci fan, right? Because the downtrend was only a few months, but it still works. And there it is, popping above the 200-day moving average. So I continue to build out my energy exposure. Top stocks to watch. My last piece to the energy puzzle is going to be the refining stocks. Now, they've already taken off. I've kind of missed them a little bit, so I have to wait. But Valero, PSX, MPC, and Dyno are my favorite 4 refining stocks I'd like to get in the portfolio. Okay. Moving on. What else I got for you? Oh, yeah. Let's wrap it up with a discussion of one of my favorite spinoffs. We're long. Our biggest position in our fund, our flagship fund, our biggest position percentage-wise is Honeywell, from that green box right here. We added it right there. So we added it somewhere around 200 level. And now it's traded around, 245 or something like that. Just a total skyrocket. Along with that, the reason fundamentally this was on our whiteboard is that Honeywell's following the GE strategy of breaking up the parts. They're worth more than the whole. They're doing spinoffs. Okay. Top shelf spinoff. We've already made money once on Solstice Advanced Materials. This is a really important spinoff to me. I can't wait to add to it. And the stock, when I started this conversation, was down 3%. Damn it. Now it's up. Oh, it's trading at 64 now. I was hoping to buy this thing down here at 61. It announced earnings, and the stock was off a little bit. Gosh, I was hoping to buy that on weakness. Looks like it's up right now, but I'll be watching that today. I'd like to get that back into the portfolio. Rounding it out with our last discussion. Yesterday, we went over Qnity, okay? You can, again, go to our Substack, read the story on why we're buying Qnity. This is a spinoff from DuPont. It's a chemical company, right? This is the cup and handle. You can see it clearly. We own it in the green box. Okay. Did any of you see or watch the Elon Musk interview last week or something? It's like a 3-hour interview. You can find it on X. Fascinating interview. Watch the whole thing. Really interesting. A lot of takeaways. But the single biggest takeaway for me, is that the insatiable demand for AI data center chips is leading to, as we know already, an absolutely insane explosion in the need for chip equipment companies. And on top of that, these chips are more and more complex, so they require larger and larger quantities of consumables that go into making the chips. And so while ASM lithography, AMAT, LRCX, these stocks are up big, and they're going through that CapEx cycle where there's just massive amounts of CapEx going into building out more fabs, okay? But to me, the real winner is going to be the dominant consumable plays. Because, look, the chip equipment guys go through boom bust cycles. Right now, it's a boom cycle. Everyone's building new plants, new equipment, and then that cycle peaks. But what doesn't peak, right, is when all of that's built, more and more chips being made, and the demand for the consumables just goes like this. And there's 2 stocks I want to own in the portfolio. This is one of them, spun off from DuPont, dominates the back end of the chip manufacturing process when it comes to consumables. Go read you can read our Substack about it, ARMR investing.substack.com. It's up there. You can read what I'm saying. So on the one hand, I want this stock, dominant player, wonderful spinoff. Thank you, DuPont, for spinning this off, right? And the other has to be ENTG. I have to own this stock, and I'm going to share with you this weekly pattern of Entergy. They just announced earnings. You can listen to the conference calls. Total blowout. Okay, that's the pattern. Okay, that's a huge weekly pattern about to break out. They dominate the front end of the clean room. Okay, so first you get the explosive move in the chip equipment companies, and then right behind that comes the explosive move that lasts even longer from the consumable guys. I'm going to own both of those in a big way. All right, so those are my thoughts for you today. I hope you find them helpful. They fit my risk tolerance. I say I'm going to own these things in a big way, but from this conversation, if they hit the stop, back to cash, back to the whiteboard, look for another opportunity. I have a lot of ideas that I love just as much as Qnity, just as much as Energous, Energris. I think I called it Energy. Energris, right? So they're on the whiteboard. When they set up, I put money to work. That's my risk tolerance. You figure out your risk tolerance, what your strategy is, go execute that, and be the smart money.